Welcome back to the Profit Logic Accounting 101 series. If you've been following along, you've watched and seen how three friends have come together to build a summer repair business and uncovered the basics of accounting along the way. Today, their story gets bigger, and so does your understanding of accounting rules that underline all businesses. And if you haven't already watched the first video in the series, I highly recommend pausing here and watching that video first. That way, the story stays consistent for you along all three videos. Also, if you want to see more fun and easy to understand videos about accounting, bookkeeping, and QuickBooks, I highly recommend subscribing to this YouTube channel. So in the last lesson, you followed the Fix-It friends through their first few weeks in business. And without even realizing it, you learned the core mechanics of accounting. You watched them pool their money, borrow funds, buy equipment, spend on real expenses, and earn their very first revenue. And through the story, you learn how to track what a business owns, who has claim on it, and why the accounting equation assets equals liabilities plus equity must always remain in balance. You also learn the difference between investing in long-term assets and spending money on items that get used up quickly, also known as expenses. You saw how expenses reduce earnings, how earnings flow into equity, and why profit and cash are not the same thing. A lesson that even experienced business owners often forget. So now that you know how money moves inside a business, we're ready to level up. In this module, the Fix-It friends aren't just mowing lawns anymore. They're about to turn their old backyard clubhouse into a revenue-generating space. And that means we're going to introduce a new set of accounting fundamentals, building on everything you learned in the last episode. You'll start to see how inventory, improvements, cost of goods sold, and rental income fit into the same simple scorecard system you've already mastered. In the first video, you saw how a business starts. In this one, you're going to see how a business continues to grow. So let's do a quick recap of the terms we learned in the last lesson and what happened since then. So remember how the Fix-It friends started. They each put in their own money. That was owner investment, their equity. They borrowed a bit from mom. That was a loan, a liability. They bought a mower. That became an equipment, an asset. They printed flyers and bought gas. Those were expenses, the cost of running the business. They mowed lawns and painted fences, which created sales, their revenue. So at the end of the first chapter, they had some cash in the box, a mower they still owned, a loan that they still owe, and profit that they've earned. Pause here and ask yourself, do you remember the golden rule? That simple equation that underlies all of accounting theory? Assets equals liabilities plus equity. Again, that's what we have and who owns it, or who's owed it, or who has a claim on it. That rule did not go away after the first startup week. It didn't go away when they got busy. It never goes away. Every single choice a decision makes with their finances has to go into that equation. So keep that at the front of your mind as we go through a whole new set of scenarios. So it's now been a month. Picture the backyard at sunset. The jobs have gone well. The Fix-It friends are sitting on the clubhouse steps, counting their money. Let's put some numbers to it so our scorecard is clear. Right now, at the end of their first phase, they have $40 in cash. They have a mower, a piece of equipment worth $50, a loan from mom that's $25, equity worth $65 total, which is their $30 original investment plus the $35 profit they've earned so far. Let's check that in the accounting equation together. We got assets equals cash, $40, plus mower, $50, for a total of $90. And then we have liabilities and equity for a loan of $25 plus equity of $65, which also equals $90. We're in balance. Say it with me, always in balance. Now look at that clubhouse behind them. The paint is peeling, one window is cracked, the inside smells like dust and childhood secrets. It's not very impressive. Sam squints at it. Hey, what if we fix it up and rent it out? Homework club, they suggest. A quiet place where younger kids can come after school for 2 hours a day. And what about like birthday parties on Saturdays? And a Friday night movie club? Jordan's eyes go wide. So instead of only getting paid when we push a mower, we get paid because we own something useful? Keep in mind, this is the heart of real estate investing, or a rental service business, but disguised as a kid idea. Here's a question. Is this new idea still a service business? Or is it also a form of a property business too? Exactly. It's more the latter. So now we have both, service and rental. So the bookkeeping needs are going to keep adding up. Now we slowly, carefully walk through the next decision. The Fix-It friends agree to spend $30 of their existing cash to repair and decorate the clubhouse so other kids will actually want to rent it. They buy lumber to fix the steps, paint for the walls, string lights to make it cozy, and a couple of cheap chairs. Pause with me and ask yourself, are these items for a one-time job, like painting a fence for the neighbor? Or are they meant to transform the clubhouse into a long-term money-making asset? Think about it. Will this clubhouse renovation help them to keep earning money week after week, month after month? Yes, it would. So now we stop and make a decision. Do we treat that $30 as an expense, something that reduces this week's profit? Or do we treat it as an investment, something that becomes part of an asset that will help them for weeks to come? Again, this is the difference between expensing and capitalizing. Let's go over the definitions again clearly. Expensing means you record the entire cost right away. The money is gone, the benefit is short-term, and your profit for that period goes down. You expense things like gas for the mower, cleaning supplies, or snacks, because once you use them, they're gone. The benefit doesn't really last that long. Capitalizing is different. Capitalizing means you're buying something that will benefit the business for more than one period, like equipment, improvements, or property. Instead of hitting your profit all at once, you turn that purchase into an asset and spread the cost over its useful life through depreciation. So for the Fix-It friends, that $30 of clubhouse improvements is not a simple one-time expense. It's money spent to upgrade a structure that will keep earning rental income time after time and over the long run. Now let's connect this to taxes, because this is how the IRS thinks too. The IRS allows you to deduct your expenses immediately, so within that year period, where the year's worth of expenses are deducted from the year's worth of income, because those expenses really only help your business for a short time. But long-lived items, things like tools, equipment, renovations, and buildings, must be capitalized and deducted slowly over years through depreciation. And why is that? Because the IRS wants your tax deductions to match the period in which the asset helps you earn money. You're not allowed to take a huge deduction today for something that's going to help your business for the next 5 years. Instead, you take smaller deductions each year through depreciation, because the IRS wants you to pay a fair share of taxes. So in the Fix-It Friends world, cleaning supplies are an expense. Snacks are an expense. Fixing a broken light bulb is an expense. Renovating the clubhouse so it can become a rent-out space, that's capitalized. The clubhouse space is basically becoming a value on the Fix-It Friends business's balance sheet, and the cost gets deducted slowly over the remaining life of the clubhouse. Deducted slowly over time through depreciation. This is the same thing that real estate businesses and investors need to do as well. So again, ask, is this a short-term cost that just disappears? Or is it a long-term investment that continues to earn? Let's run it on the scorecard so it's crystal clear. They spend $30 cash, so cash goes from $40 to $10, but that $30 doesn't disappear. It moves into a new asset called clubhouse improvements, a form of property, for an asset of $30. Now recalculate. We have assets, cash with $10, mower worth $50, the clubhouse worth $30, for total assets of $90. For liabilities, we still have a $25 loan from mom, and equity still $65. Nothing has changed in total profit yet. Liabilities plus equity equals 25 plus 65 for a total of 90. We are still imbalanced. I'm going to put my glasses on for the remainder of this lesson. So we ask again, did total profit drop when they spent the $30? No, it did not. And why not? Because they didn't use it up. It was put into an asset. Because when you buy something that's big and it improves something with long-term benefit, then you capitalize it. And in that case, it becomes part of your assets, not an expense. This is exactly how contractor clients treat renovations, how investors treat a flip rehab, and how a business treats major upgrades. Same logic, same rule, different story. By the way, if you're enjoying this kind of story-driven style of teaching, be sure to give this video a thumbs up and let me know in the comments section below if I should continue making lessons in this style for other topics. And please let me know what those topics are that are of interest to you regarding bookkeeping, accounting. I'd love to take any topic and break it down in a very simple way. All right, moving forward. Now our Fix-It friends want to make the clubhouse even more attractive. Jordan reminds everyone that parties need snacks. And Sam also concurs and says snacks make money. So they take $10 of their cash and buy chips, juice boxes, and candy that they plan to resell at the clubhouse events. Let's stop and ask ourselves, are those snacks meant for the Fix-It friends when they're working on the clubhouse? Or are they bought to resell to customers? They're bought to sell. So we ask ourselves, are they a short-term expense when we buy them? Not yet. Do we still own them? Yes, we do. And are they going to be turned into cash later? Yes, they will. So what do we call things that we buy now in order to sell later? That's right, we call them inventory. Let's run this on a scorecard. The kids had $10 in cash, which they spent on the snacks, so now they're down to zero. Our assets now look like $0 in cash, $50 in a mower, $30 in a clubhouse improvements, and now inventory for snacks worth $10. Our total assets are worth $90. And liabilities, we still have the $25 loan from mom and $65 in equity. They're still perfectly in balance. The equation still holds. So say it again so that it sticks. Inventory is an asset. Inventory is stuff we plan to sell. It stays an asset until we sell it. And then when we do sell it, it becomes what is known as cost of goods sold on the income statement. Now with inventory, there's two ways of tracking, which are first in, first out, and last in, first out, which makes sense when you're selling an item over the long term, and the cost that you pay to acquire the items changes over time as well. This is a little bit more advanced for what I want to teach here. So just to keep things simple, we're going to use the first in, first out approach for this simple story. And if you are a business that keeps inventory, I highly recommend learning those terms as well. So if we look at our scorecards, we see that inventory begins its life on the balance sheet. Once it's sold, that information moves over to the income statement, also known as profit and loss statement. And there it comes through in the form of COGS, cost of goods sold. And all the while, cash is moving as well. But we're going to talk about the statement of cash flows in the next lesson. These three statements drive your business's financials. So once the clubhouse is painted, lights are up. It looks like the coolest place in the neighborhood. Now we get to see it in action. The homework club rents it 2 hours a day, 5 days a week, at a rate of $5 per hour. So that's $5 times 2 times 5 for a total of $50 for that week. Then the Friday night party crew rents it for 4 hours at a rate of $10 per hour for a total of $40 that week. In total, our rental revenue for the week is $90. And let's assume that every renter pays in cash. No IOUs yet. Let's update our scorecard. Our beginning cash is $0. If we add the rental cash, it's now up $90. None of the inventory has been sold yet, at least at this part of the story. So snacks are still on the shelf as an asset. So our assets at the moment include $90 in cash, $50 for a mower, $30 in clubhouse improvements, $10 in snack inventory for a total of $180 worth of assets. On the other side of the equation, we have $25 in loan as liabilities plus $65 in equity. Now, note that we've earned $90 more in revenue, so our earnings have to increase by 90 as well. In this case, equity becomes $65 plus $90 for a total of $155. Now let's look at the right side of the equation. For liabilities and equity, we have 25 plus 155 for a total of $180. And we are in balance again, because we always have to remain in balance. Now let's zoom the camera to the income statement for the week. On our income statement, for rentals only this week, we have rental sales for a total of $90. Cost of goods sold are 0 because we've not used any inventory, which leads us with a total gross profit of $90. We also see expenses at $0, which will leave us with a net profit of $90. You'll notice here that we have something called gross profit. That is the difference between total revenue minus the cost of goods sold. We're not including expenses in the mix when it comes to gross profit. That comes later, which will give us the net profit. So let's ask ourselves, where does that $90 profit go? It goes back to the balance sheet in the form of equity. Profit doesn't just float in space. It becomes part of what the owners are entitled to in the business. So remember, profit on the income statement becomes equity on the balance sheet. This is one of the more important connections in accounting. All right, let's start talking about snacks. During the weekend rentals, the kids at the parties buy snacks. The friends end up bringing in $20 in snack sales. So all $10 of the original snack inventory are sold. Let's break this down in the accounting statements. For cash, our $90 increases by $20 for a total of $110. Now what happens to the inventory? We no longer have those snacks. Inventory goes from 10 to 0. But that $10 did not just vanish. Here's the key question. Does that $10 stay an asset? No, it does not. We use that inventory in order to make the snack sales. That cost now becomes cost of goods sold, otherwise known as COGS. Let's write the snack section on the income statement. We have snack sales of $20 with snack cost of goods sold for $10 for a snack gross profit of $10. So what's the total profit for the week so far? From rentals, it's $90. From snacks, it's $10. And the total net profit before expenses was $100. Now let's sync back with the balance sheet again. Equity was $65 before this week. Now we've added $100 of new profit. Our new equity is increased from $65 plus $100 for a total of $165. Now let's recalculate the balance. We have $110 in cash under assets, $50 as a mower, $30 as a clubhouse improvements, and $0 in inventory. Our total assets are worth $190. For liabilities, we have a loan worth $25 and equity worth $165. Our liabilities plus equity is $25 plus $165 for a total of $190. Still balance under the same accounting rule. So let's go over two important formulas from this scenario. We have sales minus cost of goods sold, which equals our gross profit. And our gross profit minus expenses is our net profit. Keep in mind as well, inventory that is not sold sits as an asset on the balance sheet. Inventory cost that is sold moves to the income statement as cost of goods sold. So unsold inventory is on the balance sheet. Sold inventory is on the income statement in the form of cost of goods sold. And that difference between what we sold them for and what they cost us, that's gross profit. Gross profit contributes to net profit. which flows back into equity. 3 statements, but it's one flow-through scorecard. All right, now reality really shows up. The clubhouse gets pretty messy after all these parties and clubhouse meetings. The Fix-It friends decide to buy cleaning supplies. They end up spending $10 on cleaning supplies, paid in cash, used to keep the clubhouse rentable. Now, again, ask yourself, are those supplies a long-term asset, like the clubhouse paint and lumber, or are they used more as part of regular operations? In this case, they're used quickly for regular operations. So in that way, they are expenses. Let's update the numbers. For cash, we have $110 minus $10 on supplies. Now it's down to $100. Assets now are cash with $100, a mower worth $50, a clubhouse improvement worth $30, inventory worth $0 for total assets of $180. On the other side of the equation, we have liabilities. We have a loan for $25. But with equity, those $10 cleaning expense will reduce the profit. So that's going to reduce our equity as well. Equity goes from $165 minus $10 to a total of $155. So liabilities plus equity, we have $25 plus $155 for a total of $180. We're back in balance again. So let's step back and write the full income statement for this week. Under sales, we have $90 from rentals, $20 from snacks sold for total sales of $110. Under cost of goods sold, we have the snack inventory worth $10 for a gross profit of $100. Then we have cleaning expenses worth $10, which brings our net profit down to $90. Keep in mind and remember that net profit is also known as the bottom line because it is literally the bottom line on the income statement. So let's check against the change in equity. We started the week with equity worth $65, and we end with the equity worth $155 because it increased by $90 from that net profit. It's a perfect match. Can you see it? Do you see how every sale, every cost of product, every expense will show up in cash, in profit, and finally inside equity on the balance sheet? This repetition is highly intentional. I want to make sure you're walking away from these lessons with these accounting principles ingrained in you. This is how you should be thinking in your business accounting as well. All right, now we're going to sprinkle in 3 final concepts for this lesson. So one Friday, a parent asks, "Hey, can I pay you next week? We forgot our wallet." The Fix-It friends decide that they'll let them pay later for a $10 rental. So, do we have that cash yet? No, we do not. Do we have the right to receive the cash? Yes, we do. And that right is called accounts receivable. This is the total of funds that we are entitled to from customers or clients who received services or goods but have yet to pay. So here we record in our assets. Under accounts receivable, we add it in $10. And we also increased rental sales on the income statement by $10. However, there's no cash yet. Now we flip it around in a different scenario. In the same way that you can be waiting to receive money from your clients, so too can you wait to pay your vendors. On a different day, the kids buy cleaning supplies on account from the corner store for $15, promising to pay the store owner next week. So now, do they have the supplies? Yes, they do. Do they owe the store money? Yes, they do as well. What they owe them, this is known as accounts payable. It's a liability. So we record under liabilities, we have an increase in accounts payable of $15 plus a cleaning expense of $15 on the income statement. We don't have any cash showing yet. Nothing has left the bank account. But this concept of accounts payable and accounts receivable, they show us that not all transactions involve cash, but every single transaction affects assets, liabilities, or equity, and eventually profit. And let's say that the parent that owed them $10 was actually ready to move and they left town that week. So he ends up not paying the kids back, which rude. So what happens to the $10 that was owed to them? That unpaid AR becomes what's known as a bad debt expense. So our account, in this case, our accounts receivable goes down by $10 and the bad debt expense goes up by $10, which shows up in equity as a negative $10 in profit. No new cash came into the mix, but the scorecard is tracking reality. So let's connect it back. Accounts receivable equals money owed to us we expect to get paid, and accounts payable is money we promise to pay a vendor. And bad debt is the money that's owed to us in cash that never arrives. So we call it an expense instead. So let's look at where everything stands after all the accounts receivable, payable, bad debt expenses, and sales. So our balance sheet shows assets with cash at $100, accounts receivable at $0 because it went up by $10 for the rental, but then down again by $10 for bad debt, a mower worth $50, a clubhouse with improvements worth $30, inventory at $0 for total assets of $180. Now with liabilities, we show a loan worth $25, accounts payable also worth $15, which were the supplies bought on account, for total liabilities of $40. With equity, we started the week with $65 in equity, and changes during the week, we saw $110 profit from sales, minus $10 in cleaning expenses, minus another $15 in cleaning supply expenses, which are in the form of accounts payable, minus $10 in bad debt. And this net change shows us an increase of $75. So our new equity is $75 plus $65 from last week for a total of $140. Now both sides match. We have assets worth $180, which equals liabilities of $40 plus equity of $140 for a total of $180 together. Okay, so at this point, the Fix-It friends started with a simple service gig, used profit to build a small rental property. They added in inventory sales. They tracked sales, cost of goods sold, and expenses. They were introduced to accounts receivable, accounts payable, and bad debt. And they watched all this flow through the balance sheet, the income statement, as well as another statement that we're going to get into in the next lesson called cash flow statement. And you've seen the same fundamentals come through this time as well. Assets equals liabilities plus equity, the accounting equation. And we also learned sales minus cost of goods sold minus expenses equals profit. Profit flows into equity on the balance sheet. Inventory also lives on the balance sheet, at least until it's sold. And every transaction touches at least one of these three financial statements. So in the next and final lesson, we're going to talk about the third statement, that of statement of cash flows. We're going to see how profit can look really big, yet cash might seem a bit more tight. And we're also going to see how loan payments are split between principal and interest. And we're going to see how everything comes together for the end of the Fix-It Friends summer. Keep in mind that if you can follow it for a clubhouse, you can also start following it for your own business. Whether you're a contractor, a real estate investor, a small business owner, or an online brand, it's the same logic, the same math, the same kind of story. And if you want to see more accounting and bookkeeping videos that are simple to follow, easy to understand, again, be sure that you're subscribed to the Profit Logic YouTube channel. And let me know in the comments if there's any other accounting or bookkeeping topic that you would like me to explain in this simplistic story style as well. I'll see you all in the next video.